What is margin in futures trading? The intricate world of futures trading, often shrouded in financial jargon, is underpinned by a crucial concept: margin. This seemingly simple term, familiar to stock traders, takes on a nuanced form in the futures market, offering both immense potential and significant risk. A startling statistic reveals that, in the futures market, a trader can control a contract worth tens or even hundreds of thousands of dollars by depositing a mere fraction of that amount. This leverage, while enticing, is a double-edged sword. It can amplify gains, but it can also magnify losses with devastating speed. Margin, in essence, is a good faith deposit required to open a futures position. It acts as a security, ensuring that both parties to the contract can fulfill their obligations. Unlike in the stock market, where margin is typically a loan, futures margin is not borrowed. Instead, it's a deposit held by the brokerage firm. The amount of margin required for a futures contract varies depending on the underlying asset, market volatility, and the exchange's regulations. Typically, it's a percentage of the contract's notional value, ranging from a few percent to as high as 20%. This means that a trader can control a significant amount of an asset without tying up a substantial amount of capital. However, the leverage inherent in futures trading can lead to substantial losses if the market moves against the trader. If the value of the futures contract declines, the trader's equity in the account decreases. When the equity falls below a certain level, known as the maintenance margin, the trader is issued a margin call. This means they must deposit additional funds to bring their account balance back up to the required level. Failure to meet a margin call can result in the liquidation of the trader's position. In such a scenario, the brokerage firm will sell the futures contract to cover the losses, potentially leaving the trader with a significant deficit. While margin offers the potential for substantial returns, it also introduces significant risks. Traders must carefully manage their risk exposure, set appropriate stop-loss orders, and maintain sufficient funds in their accounts to avoid margin calls. Understanding the nuances of margin and its implications is essential for successful futures trading.